Welcome to the Achievable FINRA podcast. I'm Tyler, the founder of Achievable, and we have affordable courses for the FINRA SIE, Series 6, Series 7, 63, 65, and 66 exams with industry best pass rates. Each Achievable course includes everything you need to pass the first time. A full textbook, videos on key topics, thousands of questions backed by our memory-enhancing algorithm, and full-length practice exams. You can try it out for free at achievable.me. And if you like it, use the code podcast to get you 10% off at checkout. This podcast was made from a video by Achievable's FINRA course author, Brandon Rith. If you'd like to have the visual aid of a video, please go to Achievable's YouTube channel and search for the video by the same name.
Let's break down this long call option quote. Long 1 ABC Jan 50 call at 4. One of the most important aspects of options is understanding the language. So let's make sure every part of this options quote is crystal clear. First, the word long, which can relate to a few different things. Long most often refers to ownership or simply buying an investment. When an investor is going long an option, they are purchasing the option. Essentially, they're purchasing a contract that will give them the right to do something. That's the key here. Buying an option always provides a right. And we'll talk more about that right here in just a bit. Investors purchase option contracts in specific numbers, and there's one contract here. Each contract has control over 100 shares of stock. Therefore, this option contract covers 100 shares of ABC stock. ABC is a made-up fictional company. In the real world, there are options on many publicly traded companies like Nike, Bank of America, and Home Depot. A Nike option, for example, would give control over 100 shares of Nike stock. Most option questions will utilize a fictitious company like ABC or XYZ for the main purpose of keeping the question fairly general. Each option will also have an expiration month, which marks the end of the option. Options typically expire on the third Friday of the month cited in the quote at 11:59 p.m. Eastern. So we can safely assume that this option will expire on the third Friday of January at 11:59 p.m. Expiration is important because options have something called time value, and we will visit that idea later in this video. Long call options provide the right to buy 100 shares of stock at the strike price. $50 is the strike price. For as long as this option is in existence, the investor will have the right to buy 100 shares of ABC stock at $50 per share, regardless of where ABC stock's market price goes. The benefit of an option is always in comparison to the underlying stock's market price. If the option provides a better transaction price than the market, then the option has something we call intrinsic value. Let's assume the market price for ABC stock is currently at 51. This long call provides the right to buy ABC stock at 50, which is $1 cheaper than the market is offering. Therefore, this option has $1 of intrinsic value on a per share basis, or $100 of overall intrinsic value given that every option covers 100 shares of stock. The longer an investor has until expiration, the more time and opportunity they have for the market price to rise considerably. And the higher the market price rises, the bigger the profit to the investor. Let's assume this option is purchased, and then shortly after, the market price rises drastically to $90 per share. If the investor wanted to make an immediate profit, they could exercise the option, buy 100 shares of ABC stock at $50 per share, and then take those shares immediately and sell them in the market at $90 per share, netting a $40 per share or a $4,000 overall profit just because of the exercise. Again, the more time an option has until expiration, the more opportunity an investor has for something like this to occur. The last part of this quote is the premium, which is the $4 in the quote. The premium is the cost of the contract on a per share basis, so that means this contract really costs $400 overall. Nothing is free in finance, and neither is the right to lock in a purchase price for a considerable amount of time. We will learn more about this later in this chapter, but there's an investor on the other side of this that's selling that option. If the investor that's purchasing this option is gaining a right, that means that the investor selling the option is putting themselves into an obligation. Think about it this way. If you had a friend that gave you a right to buy 100 shares of stock at 50 from them, well, that means that they have the obligation to sell you 100 shares of stock at 50 should you choose to exercise that right. The buyer pays a premium for the right, and the seller receives the premium for their obligation. And that's the game of options. Basically, two investors betting on where a stock price will go. The premium can be broken down into two components that we've already mentioned: intrinsic value and time value. As a reminder, the intrinsic value reflects the option's current exercise value. Let's again assume that the market price of ABC stock is currently 51, which would mean this option that provides the right to buy ABC stock at 50 has $1 of intrinsic value because it allows a purchase $1 cheaper than what the market is offering it for. To find the intrinsic value of any given option, you really only need two things: the market price of the underlying stock and the strike price of the option. If the option provides a better transaction price than the market, then the option has intrinsic value. An easy way to remember this is actually the term call up, put down. Given that this is a call option, we'll focus on call up. Call options have intrinsic value when the market price goes above the strike price. Call up. If the market price were to go below the strike price, the option does not have intrinsic value. For example, would it make any sense at all for you to exercise an option that gives you the right to buy stock at 50 if the market price was, say, 45? No. It would make no sense to use the option, and at that point in time, the option would be considered worthless, at least from an intrinsic value standpoint. Now, let's go back and again assume the market price is 51 and that we have $1 of intrinsic value. The remaining part of the premium represents time value, and with a little bit of algebra, we can actually figure out exactly how much time value is involved with this option. If the premium is $4 and the intrinsic value is $1, then the time value must be $3. Breaking down the option this way really helps an investor understand exactly what they're paying for when they purchase an option. $1 per share or $100 overall is paying for the intrinsic value that the option already provides. $3 per share or $300 overall is paying for time in hopes that the market continues to rise further. If this were an option with a longer expiration, we could safely assume its premium would be higher just because of time value. A February 50 call, for example, would have a higher premium. When comparing a January 50 call to a February 50 call, both options provide the same rights: the right to buy 100 shares of ABC stock at 50. However, the February option lasts 1 month longer and gives more time and more opportunity for the market price to rise. Let's say that the February 50 call has a premium of 6. Still assuming a market price of 51, the February 50 call has $1 of intrinsic value, just like a January 50 call would. However, the time value of the February 50 call would be $5, which is $2 more than the time value of the January 50 call. Now, just so you know, these are numbers that I'm just making up, but this is how it works in the real world. The longer the option, the more time value and the more expensive the premium. Premiums fluctuate on a day-to-day basis, similar to stock prices. Supply and demand determines each option's premium, and a more valuable option will have more demand and therefore a higher premium than a less desirable option, especially if that less desirable option has less time associated with it. Now, we're getting towards the end here, so let's go ahead and summarize everything we've talked about. Long calls provide a right to buy 100 shares of the underlying stock, which is ABC stock in this example, per contract at the strike price, which is $50. The $50 strike price stays fixed regardless of the direction of ABC stock's market price. The option expires on the third Friday of January at 11:59 p.m. Eastern. The premium reflects the cost of the option, which is currently $4. Of course, that's on a per share basis. So this option will cost $400 overall to the investor that purchases it.